No tenants, no toilets, no vacancies. That's all the responsibility of the owner, not you as the note holder. Seven benefits of the note business. And I'm going to move through these very quickly, and I'm not going to read everything. Okay. So what I want you guys to do is turn on your cell phone, take a picture if you want to, do a screen grab, and then you can just have the seven benefits. Okay. But I'm just going to highlight the things that I feel are of the most importance to you. Okay. Obviously, benefit number one, passive monthly income. You guys have got to have passive monthly income. Now, this is one of the reasons why banks don't like fixer and flipper people. Now, I remember when I started flipping houses back in 1996, I was doing pretty well to the point that I thought, well, now, maybe banks will take a risk on me. They wouldn't, because they would say, Lee, your flipping business has no consistency. There's no reliability. There's no predictability. There's no guarantee that you're going to flip a house next week or next quarter or next year. Therefore, the income that you've generated in the past is nothing that we can anticipate or rely on in the future. But with a real estate note, that's not true, because I said it and I forget it. I buy the note at a predetermined price, at a predetermined interest rate with monthly payments required. Now, already one of you is out there, well, what if they default? What if they stop paying? Guys, we're going to teach you how to buy notes that have a very, very, very low risk of default. And if they do default, how you can actually come out ahead. So a default would actually create a greater profit for you than if they actually pay on time. Now, I want you to think about what I just said. Either we get all of the money that we agreed to get when we bought the note in the first place, or we get more. Now, I think those are two pretty decent outcomes. Now, how do we get the more? The second part of that is how you buy, okay? In real estate, we make our money when we buy. We realize our investment when we sell. So if we buy wrong, we're not going to be able to get out, and it could go wrong. But when we buy right, doesn't matter what happens, we're going to come out right, okay? So the due diligence part of this is really critically important. Here's the good news. We'll look at anything you got, okay? You got a note you're interested in buying? Let us look at it. I'll give you my opinion. Hey, I don't think you should buy this note, and here's why. I had a conversation with a gentleman today. He had put a piece of property under contract, and he said, Lee, what do you think? And I said, absolutely do not buy that piece of property. It's in a terrible location. The numbers are wrong. The comps are inaccurate. Don't buy that property, okay? Helping you guys be successful actually helps me and this organization be successful, because we get more of what we want by helping you get more of what you want. So if I can help you generate more income, both active and passive, we can collectively make more money together. And as we make more money together, now we have more money that we can serve other people. That's why this works so well, okay? So number one, again, passive monthly income. Number two, it is secured. Now, boy, I was busy today. I had another conversation with a client who had lent money on a property that had gone, that the collateral wasn't secured. So it was an unsecured loan to a friend. Sorry, you're never going to collect that loan, okay? If you don't get collateral, okay, if you don't have that meets and bounds tax ID number with a title insurance company saying that you're in first trust deed position, you shouldn't write the loan. Now, everybody that I've talked to who's gotten burned doing this has done everything opposite of what I've told them to do. Now, in their defense, I didn't know them, they didn't know me, and I didn't look at their deal. But my goal through this presentation, you guys, I want you to understand the structure and the simplicity of this. Is really not that hard, but you got to make sure that you have all of these things in place. So it must be backed by real estate, okay? Now, this will benefit or generate for you typically higher yields than what you would get through your 401k or your Social Security or your retirement accounts, okay? Now, we all know that if you take a timeline, okay, If you take the American Stock Exchange from like 1913 to present day, and you take a magnifying glass and just move it over any 10 years, and there's some cool things online you can find that will do this for you, but you take this little slider bar and you just move it around, and you can take any 10-year period of time in the stock market, and it's going to average you about 7%. Now, there's going to be highs, some 30%. There's going to be lows, 60% declines. But if you stay in and don't sell, you're going to get about 7% annualized growth in your 401k, okay, or your stock investments. Here's the problem. When you sell the stock, you create a taxable income because you've sold an asset, but you also reduce the number of shares that you have. So if the stock continues to climb, you actually get less or participate in less of the increase. Now, in the note business, when we buy a note, we are locked in. So if I buy a note right now today at 11%, that note's 11%. It doesn't matter if the market goes up, goes down, if tariffs go up or down, doesn't matter. I get 11. And if the borrower for any reason stops paying me, I get the property. And if we've done our due diligence correctly, I should make more money in default because of the deal. Now, the other great thing about it is when I buy a note, I get a payment every single month. The amount of the collateral against that property stays in first trustee position. The amount of the money that I lent, assuming I did an interest-only loan, stays that amount. And in 12 or 24, 36 months, whenever that loan pays off, if I bought an interest-only loan, I get all of my principal back. I don't have to sell stock. I don't have to sell interest. I retain and keep 100% of the asset the entire time that I own it. And it just keeps paying me every single month, which creates a pretty hands-off investing strategy. No tenants, no toilets. Now, full disclosure, guys, I own mini notes, and I own a lot of real estate. And I have rentals, and I have fix and flip properties, and I have notes in first lien position, and some other types of investments out there. The notes produce the most consistent, steady, reliable income with the least amount of effort. Now, some would say, well, owning rentals is passive income. I don't know that that's a true statement. I know that it's not a true statement for me. Well, what if you hire a property manager? Well, the property manager is still going to call me and say, oh, Lee, we got a call from the tenant. You need to replace the roof. You need to replace the washer and dryer. There's nothing passive about rentals, okay? They're very involved. Buying, fixing, and flipping houses, wholesaling, that is a full-time active business. Nothing passive about that. Now, here's my opinion. Wholesale, to generate the cash that you need to fix and flip, to generate the profits that you need to invest in notes, okay? I don't believe that buying and holding rental property for your long-term retirement is the best strategy. Now, certainly have it because there's no better tax write-off than rental property. They're the best, but it's not passive income, okay? It's active income. You're still actively involved. You're paying property taxes. You're paying property managers. You're fixing tenants and toilets. You've got vacancies. You've got turns. You got all this stuff. It's active, okay? But if we can take your portfolio and take some of your active income and put it into some of these passive note opportunities and blend your portfolio out a little bit, I think you're going to get greater monthly income with less monthly headache. And that is the benefit. Number 5, there are millions of private mortgage notes in the U.S. and millions of mortgage loans, privately held mortgage loans, are created every single day. This is not one of those investment opportunities where, oh, you got to get in now because, it's going to disappear. Hasn't disappeared in 300 years. I don't anticipate it's going anywhere. But one thing that is true, when interest rates go up, you see far more seller-financed mortgage paper being written than when interest rates are low. Because when interest rates are low at 3%, that means the bank is only offering me 1.5% on my CD. So if I sell my house in a 3% rate environment, what am I going to do? Just shove it in a 1.5% rate? But when rates go up, as a seller of a piece of property, I have one of two options. I can either drop my price to make my home affordable based on the rate, or I could offer to carry financing on behalf of the borrower. Now, rates, as we know, I said this at the top, 6.5% are where rates are sitting right now. As a seller of a piece of property, I could sell a house right now and charge 5.5% interest and still be getting far better than I would be getting in bank rates. Because right now you can get a CD that's paying 3.5 to 4, which is good. But if I can sell or finance and get 5.5 or 6, even better. Number 6, building wealth. Okay, guys, with notes, we're not gambling on appreciation. We are simply buying income. We're stepping into an existing flow of income already exists. We're just stepping in and having those payments now go to us, which is what gives us the ability to create scalability and legacy wealth. Okay, now you can start with one note and scale to dozens over time. I have a client right now that has over 100 notes. Now, this is just a private individual, 100 notes. His notes are paying all of his expenses. He's now living in a very, very nice adult care facility, one of those really nice ones. He told me I think he's paying 12 or 15 grand a month for this facility, and notes are paying for all of it. And as he's developing and putting his will together, all of those notes, all of that income will transfer to his kids, to his estate. So he set it up, put them in a trust. He passes, all of that trust transfers, and now his kids benefit from the monthly income that the notes are creating. Now, I can tell you, as somebody that's been buying and fixing and flipping houses for the last 30 years, I've gotten a lot of calls from kids who have inherited real estate, desperate. Oh my goodness, Lee, my parents they owned this apartment building and they passed away and it's gone down, and can you just buy it and get it off my hands? See, because when you transfer real estate to your kids through your estate or through your trust, you're transferring liability and ownership of the property, taxes, insurance, collection of rents, maintenance, keeping the facility up. And if they don't have access to the cash from the transfer of the estate, they can't fix anything. Well, pretty soon, if you can't fix it, the tenants will leave, property will go into disrepair, and value will decline very rapidly. So I can't even begin to tell you the number of phone calls I've gotten from very distraught, worried kids who inherited real property when mom and dad died. I don't know that leaving property to your kids is the best option for them. What if we sold the property, took the cash, put it in notes, set it into a trust, and then when we die, they just inherit the trust and the monthly income? Because these notes are being serviced by a third party. All we have to do is collect the payment from the borrower, and the rest is yours. That's it. No tenants, no toilets, no vacancies. That's all the responsibility of the owner, not you as the note holder.